Fed's Powell delivers a stark warning, but are markets tuning him out? Fed Chair Powell sent a clear message on Tuesday: there's no easy path forwards. With inflation still sticky and the labour market showing cracks, Powell struck a cautious tone, far from the dovish pivot traders were hoping for. But markets are still pricing in cuts by the end of the year. So is Wall Street ignoring the warning signs or just betting Powell will blink first? Chris Beauchamp is Chief Market Analyst at IG. So Chris, Powell gave no signal whether cuts are on the table in October. Is that still a live possibility, or are markets getting ahead of themselves?
It's still a live possibility. I think it's understandable if you look at stocks trading at or near record highs and the concerns about what's the fuel for the next leg higher, if there really is one, that they would look to Powell to provide some kind of firm direction. Unfortunately, he is an expert at this and is not going to give people the hints of rate cuts just to chivvy the stock market higher. I know the Fed is also beginning to note concerns about valuations again. So this is lurking in the background, I think. There's still an easing path. I think that's the sort of assumption we took from last week's decision. But to assume that they would come into a speech yesterday, barely a week after the meeting, and really give people the next heads up. They were lucky enough to get one at Jackson Hole. You don't get two in a row, really, from Jerome Powell. So I think it was just a case of the market really just getting ahead of itself in the short term.
Well, Powell's caution also underscored growing divisions within the Fed. How should traders position themselves as the internal split becomes a market catalyst?
Well, I think they position themselves in a way that suggests that we do see more easing to come. There's a clear bias within the committee, and the employment data, and of course we get more of that fairly soon, the employment data reinforces the view that there is space to cut. Now, how much a slightly spikier inflation narrative would come into spoil that remains to be seen. But certainly from most committee members' point of view, they're happy to move in the direction of further easing. Not as fast as the president wants them to go, or indeed as Stephen Miller wants them to go, but nonetheless in that direction.
Let's talk about data now. And US business activity slowed in September, hitting its weakest pace in 3 months. Could this be a sign that tariffs are biting?
Well, yes, and it remains a concern. And it's remarkable how much tariffs have sort of dropped out the headlines but remain as the undercurrent of discussion. And we look for any signs that we can link weakening activity to tariffs or rising prices to tariffs. We're in danger, of course, of overinterpreting the data at this point. I think it requires a sustained period of weakness to really begin to put a firm label on what we're seeing. But I think, again, it's all being viewed through the prism of these markets sitting at record highs. And can these be sustained if you're beginning to worry about the outlook for earnings? Now, earnings season was very strong, and I don't think we should read too much into one set of US data, business data. But nonetheless, everyone continues to keep this weather eye, this nervous eye on how data pans out. And at the moment, I think it's just enough to keep people concerned, but not enough to really drive any kind of major market sell-off in the short term.
Well, the Fed's preferred inflation measure is due up this Friday. What are you expecting?
With PCE, of course, the excitement happened earlier than the CPI, if there was any excitement around CPI. You would take, I think, a fairly nasty reading, much higher than expected, to jolt any expectations back towards a much more cautious policy outlook. And again, the Fed has really sent the message, both in Jackson Hole and at last week's meeting, that the employment element is the far weightier element to deal with at the present. So it would have to be quite a shocker from PCE figures on Friday to really change the narrative in any substantial way.
So finally, Chris, the OECD warned that trade policies could still deal a major blow to the global economy. If that risk does materialise, does the Fed shift into damage control?
Yes, I think it does. And I think the risk is then that you move into what you might call the bad kind of rate cuts, where they're responding to a weakening economy. And by then it might be too late. I think so. The concern from the OECD was clearly there. And I think it's the concern that everybody shares, that every month we sort of play the game of, will tariffs show up in the data? How much will that really impact activity? And so far, it hasn't really begun to have a major effect. If you look at how quiet this rally has been, volatility is low, stocks obviously still at record highs. There isn't that concern really manifesting itself. But every month it's the same kind of game, and it's the OECD is reminding us, and what we're already very consciously aware of is, at what point is this stuff really going to begin to have an effect? At what point are markets really going to care if there's a material weakening in data, and how much can the Fed do to really offset that?
That was Chris Beauchamp from IG. Don't forget, you can watch more videos on Reuters.com.